According to a report from the U.S. Department of Commerce, the U.S. economy grew by only 0.3% in the first quarter of 2025, a sharp decline compared to the 2.1% growth in the fourth quarter of 2024. The primary reason for this slowdown lies in factors such as declining consumer spending and weak investment. Among them, tariff policies, particularly the 25% tariff on imported vehicles, have increased production costs for American companies, including Ford, forcing consumers to pay higher prices for automobiles. This has affected consumer demand and triggered widespread impacts across the economy. In early 2025, Ford withdrew its profit forecast for the year after the company recognized that economic conditions and tariff policies would pose serious challenges to achieving its original financial targets. Original profit forecast. Ford had previously projected earnings in the range of $7 billion to $8.5 billion for 2025. However, amid rising tariffs and supply chain disruptions, the company fully retracted this forecast. Ford now estimates losses of up to $1.5 billion in 2025 due to increased costs from tariffs, along with shortages of critical components such as lithium batteries and semiconductors. These parts are essential to the production of electric vehicles and pickup trucks. This has sparked investor concern over the company's short-term recovery prospects. The sudden shift in financial outlook triggered a wave of negative market reaction, leading to a decline in Ford's stock price. To cope with the rising production costs driven by tariffs and component shortages, Ford has made several price adjustments across its vehicle lineup. Ford F-150, the company's flagship pickup truck, has seen an average price increase of 4% to offset higher tariffs and other manufacturing expenses. The price of the standard Ford F-150 model has risen from $34,000 to $35,360. This is a prime example of how companies are forced to absorb increased import costs and pass some of that burden on to consumers. This price hike could result in Ford losing some customers, especially as consumers grow more cautious with their spending in an economy marked by uncertainty. Amid ongoing tariffs and supply chain disruptions, Ford Motor Company is facing significant challenges, particularly in the production of electric models like the Mustang Mach-E and F-150 Lightning. These vehicles are not only central to Ford's sustainability strategy, but also serve as strategic products that help the company stay competitive in the global automotive industry. One of the most critical factors affecting Ford's ability to produce electric vehicles is the shortage of essential components, especially lithium-ion batteries, the core element of EV energy storage systems. Lithium-ion batteries are a vital component in the production of Ford's EV models, including the Mustang Mach-E and the F-150 Lightning. According to Reuters, Ford was short around 50,000 lithium-ion batteries in the first quarter of 2025. This shortage disrupted production lines at several Ford factories and prevented the company from meeting market demand. As a result, Ford was unable to produce enough electric vehicles as planned, particularly the Mustang Mach-E, which is the company's flagship EV. Ford had set a goal of producing 200,000 electric vehicles in 2025. However, due to the battery shortage and lack of other key components, the company failed to meet that target. This shortfall may lead to a decline in Ford's market share in the EV segment, especially as competitors like Tesla continue to produce at a steady pace without facing similar issues. Faced with shortages of key components such as lithium-ion batteries and microchips, Ford has had to implement several measures to offset rising costs. To counter the rising costs caused by parts shortages, Ford has raised prices on its electric vehicles, particularly the Mustang Mach-E and F-150 Lightning. The Mustang Mach-E has seen a price increase of approximately 5.5%, meaning consumers now pay around $2,500 more for the base model. The F-150 Lightning, Ford's electric pickup truck, has also experienced a similar price hike, making the once accessible EV truck noticeably more expensive. While these price adjustments help Ford absorb higher costs, they may also reduce the competitiveness of its EV lineup. As rivals like Tesla and Rivian maintain more affordable pricing, Ford risks losing market share and may struggle to compete effectively in the budget EV segment. The EV market is growing rapidly, and any significant production disruptions or excessive price increases could weaken consumer interest in these models. Ford is not the only company grappling with issues related to tariffs and component shortages. Other major players in the U.S. auto industry, such as General Motors, GM, and Stellantis, have also faced similar challenges. GM was forced to temporarily halt production at several plants and lay off workers due to part shortages and tariff-related issues. Stellantis, the parent company of brands like Jeep and Chrysler, also had to suspend operations at certain U.S. facilities and cut 900 jobs in response to the same pressures. This situation reflects a broader industry-wide trend as American automakers struggle to meet production targets amid a combination of supply shortages and external economic factors like tariffs. Experts warn that if these conditions persist, the U.S. auto industry could face a serious crisis. This would impact not only the company's revenues but also the national economy, as automotive manufacturing remains one of the largest industries in the United States. Ford Motor Company is facing a series of challenges stemming from tariff policies, supply chain disruptions, and component shortages. In an effort to sustain production and remain competitive in the market, the company has implemented several key strategies. However, these strategies have not been without difficulties, and their impact, both on Ford and the broader automotive industry, has been significant. To address supply chain disruptions and shortages of critical components, Ford was forced to temporarily halt production at several of its key manufacturing plants. One of the most affected facilities is the Michigan plant, which produces some of the company's flagship vehicles, including the Ford F-150 and other major models. Michigan plant. This facility is responsible for producing the F-150 pickup trucks and several other models. However, due to shortages, particularly of microchips and lithium batteries, Ford had to suspend production for a period of time. This led to reduced output and limited vehicle availability, directly impacting the company's revenue and profitability. Kentucky plant. Meanwhile, the Kentucky facility where Ford manufactures the Mustang Mach-E, its flagship electric vehicle, also had to scale back production. This disruption not only reduced the number of EVs Ford could deliver to the market, but also delayed the company's long-term electrification plans. As part of its strategy, Ford has shifted production of certain vehicle models from its plants in Mexico to Canada in an effort to avoid tariffs. However, this is not a perfect solution and cannot fully offset the damage caused by tariff policies. Shifting production from Mexico to Canada. Ford moved part of its production from Mexico to Canada to minimize tariff-related costs. While this decision helped reduce the impact of tariffs on models like the Ford F-150, which had been manufactured in Mexico, it also led to higher transportation costs and may fall short of maintaining optimal production capacity. Rising costs. Relocating plants and production lines also required Ford to make significant upfront investments in restructuring operations and retraining workers. This is a long-term strategy that does not address the company's immediate challenges. As part of its broader strategy, Ford is contributing to the auto industry's goal of reducing CO2 emissions. The company has committed to increasing electric vehicle (EV) production to meet government requirements for lower greenhouse gas emissions, pushing electric vehicles. Despite experiencing disruptions in EV production, Ford remains firmly committed to its electrification strategy as a core element of its sustainability efforts. Commitment to environmental goals. Ford has announced that it will allocate a significant portion of its budget to the development of new EV models in the coming years, despite facing short-term challenges. This move is a crucial step in helping the company meet both U.S. and global climate targets, while also reducing environmental pollution. On June 4, 2025, U.S. President Donald Trump signed an executive order increasing tariffs on steel and aluminum imports from all countries except the United Kingdom from 25% to 50%. This move was intended to protect the domestic steel industry from unfair competition and global overcapacity. However, the decision has sparked mixed reactions. American automakers, such as General Motors, GM, and Ford, have warned about the negative impact of these tariffs on their profits and supply chains. GM estimates it will lose between $4 to $5 billion in 2025 due to the tariffs, with around $2 billion of that linked to imports from South Korea. The steel import tariffs have increased raw material costs for U.S. steel producers. Steel mills are facing higher prices for imported steel, particularly from countries like Canada and Europe. As a result, the price of domestically produced steel has also risen, making U.S. steel products more expensive in the international market. Specific data. According to a report from Reuters, steel costs have increased by 6%, 8%, which translates to an increase of $54.60 to $72.80 per ton over the past year, mainly due to tariffs and raw material shortages. This has not only affected the steel industry, but also had a ripple effect on other sectors such as automotive, construction, and energy. Steel is a crucial component in automobile production, accounting for approximately 60%, 70% of the weight of each vehicle. The increase in steel tariffs has raised production costs, especially for vehicles that use thicker steel, such as trucks and SUVs. Specific data. Automotive industry experts report that the price increase of steel has raised the production cost of each vehicle by between $1,000 and $2,000, depending on the type of vehicle and the amount of steel used. Impact on vehicle prices. Automakers have been forced to raise vehicle prices to offset the higher raw material costs. For example, Ford had to raise the price of some models, such as the Ford F-150 and Mustang, by up to $2,000. General Motors (GM) adjusted its SUV and truck lines by reducing certain features like support systems, metal trim parts, or altering vehicle structures, such as the frame or load-bearing components, shifting from thicker steel to lighter steel or other materials like aluminum alloys or composites. This helped mitigate the steel cost increases while maintaining the vehicle's durability and safety. Reduced production and market share losses. With increased production costs and unstable steel supply, the U.S. automotive industry has faced a reduction in production and lost market share in international markets. U.S. automakers have had to cut domestic vehicle production. Ford has had to reduce production by about 10% for its truck and SUV models, equating to a cut of around 50,000 vehicles in Q2 2025, due to steel and parts shortages. General Motors (GM) reduced production by about 5% in Q2 2025, which is roughly 25,000 fewer vehicles from its SUV and truck lines due to the steel shortage and supply chain disruptions. Overall, U.S. automotive industry. The U.S. automotive sector is estimated to have reduced production by a total of 250,000 vehicles in Q2 2025 due to the steel shortage and the lack of critical components. Steel is an essential material in construction, used in projects ranging from residential homes to large-scale infrastructure developments. The increase in tariffs on imported steel has raised the cost of this raw material for construction companies, leading to higher project costs. Specific data. A study from the American Construction Institute estimates that the increase in steel tariffs could raise construction costs by up to 10%. Specifically for large projects like bridges and highways, this increase could add up to $10 million for every $100 million worth of construction. This could put significant pressure on budgets and project timelines for critical infrastructure. Impact on the American public. Rising home prices. According to a report from Reuters, the average home price has increased by 2.9% year over year, reaching $401,800 in June 2025. This price increase makes it more difficult for many middle-income families to afford a home. Increased rent costs. Construction companies facing higher costs and an unstable steel supply have been forced to raise rent prices or delay new housing projects. According to Reuters, the rise in rent prices has increased the cost of living for people, particularly in large urban areas. Impact on public projects. Project delays. The shortage and price increase of steel have slowed the progress of construction projects. For example, Bechtel Construction Company estimates that a 10% increase in steel prices has added an additional 2-3 months to the completion time of large projects like bridges and highways. Job losses. Project delays have led to fewer job opportunities in the construction industry and related sectors. Each month of delay could result in the loss of 1,000 to 2,000 jobs on large-scale projects. The U.S. tariff policies on steel have directly affected the energy sector, particularly renewable energy, as steel is a key material in constructing wind turbines, solar panels, and energy infrastructure. Increased costs for renewable energy projects. Energy companies are facing higher costs when constructing wind turbines and solar power facilities. PwC estimates that the cost of renewable energy could increase by $53 billion annually due to the steel tariffs. Supply chain disruptions. Energy companies are also dealing with disruptions in the steel supply chain. The shortage of high-quality steel has delayed projects and increased costs. Equinor, for example, had to report a loss of $955 million due to the rising cost of steel and supply chain disruptions. Amidst the tense tariff situation, Canada has turned the challenge into an opportunity, reduced exports to the U.S. Although Canada accounts for 22% of total U.S. steel imports, the tariffs have reduced steel exports to the U.S. As a result, Canada has sought alternative markets, increasing exports to Asia and Europe, and reducing its reliance on the U.S. increased domestic production. Canada has ramped up its domestic steel production and made significant investments in green steel, aiming to lower production costs and attract investment from the renewable energy sector. On July 16, 2025, Canadian Prime Minister Mark Carney announced a series of measures to protect and strengthen the domestic steel industry in response to the U.S. increasing tariffs on steel and aluminum to 50% for all countries except the United Kingdom. Canada will implement a tariff quota on steel imports from countries with free trade agreements, FTAs, excluding the U.S. specifically. If steel imports exceed the level of 2024, the tariff will increase to 50%. For countries without an FTA, Canada will reduce the tariff-free quota by half compared to 2024 levels and apply a 50% tariff on steel imports exceeding this quota. Canada will impose an additional 25% tariff on steel imports from all countries excluding the U.S. if the steel contains components that are melted and poured in China. This measure aims to prevent cheap steel from China from being re-exported to Canada through other countries to bypass the tariffs. The Canadian government has announced the establishment of a $1 billion Canadian investment fund to support innovation and the development of the domestic steel industry. This fund will be used to finance projects focused on innovation, increasing productivity, and reducing carbon emissions in the steel sector. Additionally, Canada will prioritize the use of domestically produced steel in infrastructure, defense, and energy projects. The measure imposing an additional tariff on steel containing components from China has sparked a strong reaction from Beijing. The Chinese embassy in Ottawa criticized this move, stating that it violates World Trade Organization (WTO) rules and disrupts the international trade order. China has warned that it will take retaliatory measures if Canada does not retract these measures. On July 10, 2025, just hours after the closing bell on Wall Street, President Trump signed a Section 232 declaration, officially imposing a massive 50% tariff on every pound of copper imported into the United States, set to take effect on August 1st. The announcement came during a cabinet meeting in Washington, where President Trump asserted, "I believe that the tariff on copper, we're going to raise it to 50%, 50%. This wasn't just a number, it was a thunderous move that will disrupt North America's supply chains overnight, pushing U.S. tariff rates to levels not seen since the Hoover era. The White House framed this action as vital to national security. However, if we look at the detail, Washington imported 810,000 tons of refined copper in 2024, meaning half of the crucial metal that supplies U.S. factories will now face the same hefty tariff as luxury cars. The announcement also quietly pushed the negotiation deadline from July 9th to August 1st, giving Ottawa, Beijing, and Brussels 3 extra weeks to sign subsidiary agreements or face locked-in tariffs. Immediately, Trump's copper tariff announcement sent prices soaring to record highs. Within minutes, COMEX copper futures in New York surged to an unprecedented $5.95 per pound. The futures contract jumped 13% in a single trading session, marking the largest one-day increase in the history of the contract. Copper prices in the U.S. are now trading 25% higher than on the London Metal Exchange, creating an unprecedented price gap. This shockwave rippled through the markets. Freeport-McMoran stock ticked up slightly, but the Toronto S&P/TSX Materials Index fell 116.71 points, 0.4%, to 26,903.57, impacted by declines in the mining sector and concerns over the effects of the copper tariffs. Reuters, Yahoo Finance, and Western Investor all highlighted how the trade war is causing damage to mining companies on both sides of the border. Canada, which refined about a quarter of the copper imported by the US last year, felt the first wave of the shock. The copper tariff is not just a trade issue, it's a hidden tax on consumers. Analysts at Cox Automotive estimate that even the 25% tariff on metals added around $6,000 to the sticker price of a car made in Canada. With this 50% tariff, that added cost could easily reach 5 figures. The impact is even greater on the electric vehicle (EV) sector. A typical electric car uses up to 80 kilograms of copper, about 4 times the amount used in a gasoline-powered car. With Trump's 50% tariff, the metal surcharge could add roughly $220 per car based on current futures prices. Even a pickup truck made in Detroit could face an additional $3,000 in costs. Homebuyers are also feeling the squeeze. A February report from CoreLogic found that tariffs on metals and lumber have increased the cost of building a new home by $17,000 to $22,000, enough to wipe out the down payment for many first-time homebuyers. A survey by the National Association of Home Builders, released on May 1st, revealed that material surcharges had added $10,900 to the price of a single-family home just 4 months after the tariffs were imposed. In total, every U.S. consumer is now carrying the weight of a trade war on 4 wheels and 4 walls. On June 30th, Canada hoped to buy peace when Prime Minister Mark Carney abolished Ottawa's 3% digital services tax. This tax was expected to raise about CAD $5.9 billion over 5 years. It was a last-minute attempt to restart stalled trade negotiations with Washington and meet the July 21st deadline for a new deal. The White House accepted the concession, but then struck back. On July 8th, the same team that welcomed Carney's concession announced a 50% tariff on copper, while warning that pharmaceuticals could face a 200% tariff if Canada didn't sign a deal before the clock ran out. Canada, the second-largest supplier of refined copper to the U.S., accounting for 17% of imports last year according to USGS data, found itself in a dilemma. However, instead of surrendering, Ottawa chose a different path: speed and redirection. Teck Resources has been rerouting concentrated ore to South Korean smelters for resale to China. Quebec provincial officials flew to Lima and Santiago in search of alternative buyers should the U.S. door slam shut. Even industry lobbyists are quietly suggesting that, with the door closed, Canada could issue export permits without fees to encourage copper mining companies to shift their focus eastward. This redirection is no longer a theory. On March 31st, Statistics Canada reported a 24.8% surge in exports to markets outside the U.S., while sales to the U.S. dropped by 6.6%. This gap is the widest in 9 years, reshaping the trade map overnight. As of July 23, 2025, despite Canada's warning of potential retaliatory measures worth CAD $125 billion on July 22nd, if Washington does not retract the 50% copper tariff, these measures have not yet been implemented. Prime Minister Mark Carney has kept this move as a negotiating strategy, allowing more time for talks to continue. Analysts at J.P. Morgan warned that if copper stays above $12,000 per ton through September, the total damage to the automotive and housing industries could reduce U.S. Q4 GDP by half a percentage point. That's a bill hanging in the balance, and it's growing by the hour. The entire story unfolds under the shadow of the world's closest economic relationship. For over 60 years, the U.S. and Canada have built this relationship on rules, not threats. That framework is now under heavy strain. Chile, the world's largest copper producer, has expressed concerns about the impact of the tariffs on its copper industry. Codelco, Chile's largest state-owned copper mining company, stated that it is facing anxiety and uncertainty from its trade partners. Mexico has voiced opposition to this decision, warning of the potential for retaliatory measures. Zambia, a major copper producer in Africa, has called on the U.S. to exempt copper imports from the country from the tariffs. Copper prices surged in the U.S. following President Trump's announcement, reaching record highs, while global copper prices on the London Metal Exchange (LME) dropped, reflecting concerns over reduced demand. Supply crisis. The U.S. imports around 60% of its copper from Chile, while domestic smelting capacity is insufficient to replace this import volume. This could lead to a copper shortage for crucial industries such as electric vehicles, data centers, and defense. Impact on industries. Industries that rely on copper such as electric vehicles, data centers, and defense, are worried about the impact of the tariffs on supply and production costs. The big question remains whether Washington will back down to avoid negative impacts on the economy and international alliances, or if it will continue to pursue its domestic production protection policy, trusting that American consumers will bear the additional costs for national security. Meanwhile, Canada remains steadfast in its position. If no agreement is reached, Ottawa may continue the balancing act between retaliatory measures and protecting its national industries. The U.S. tariff strategy could have long-term effects on both economies. For the U.S., this policy will increase costs for businesses and consumers, lead to material shortages, and damage global supply chains. Major copper-producing countries like Chile, Mexico, and Zambia could also adjust their trade strategies, altering the copper market structure and affecting U.S. industries. For Canada, although retaliatory measures have not yielded immediate results, seeking new markets will be a long-term strategy. This shift could weaken the U.S. position in the global supply chain, creating a multipolar economic world where countries are no longer dependent on a single superpower.